Hello, focus learners, and welcome back to The Explainer. Today, we're diving into a really fascinating journey through the actual mechanics of capital allocation. We're going to look at exactly how money moves, how value is built, and most importantly, how risk is managed. We'll start with a pretty wide lens, comparing traditional business foundations with the hyper-fast world of trading. And then, we're zooming all the way in to unpack the high-leverage, high-stakes world of financial derivatives. By the end of this explainer, you're going to have a crystal clear understanding of how these wealth-building mechanics actually work. Here's our roadmap for today. First, business versus trading. Second, what are options? Third, understanding call options, followed by put options. And finally, we'll wrap up with the double-edged sword of leverage. Let's get right into it. Okay, let's dive into this. Section 1, business versus trading, the fork in the road. So whenever you have capital, you basically face a fork in the road, right? There are two primary paths for your money. You can either build something over time or you can move things quickly. That right there is the fundamental difference between running a business and actively trading. Let's look at how these diverge. If you go the normal business route, you're focusing heavily on long-term value creation. Production, services, steady growth. You're building something from the ground up. Now, trading is an entirely different beast. It relies purely on speed and price movement. There's literally no production involved. The whole model is just buying ready goods cheap and selling them high. You're capturing the movement of value rather than creating the value yourself. When we map these trade-offs out side by side, the contrast is pretty stark. A normal business requires high initial capital, while trading, you can start that with very low capital. But then look at the risk and stability factors. Business gives you high stability and medium risk. Trading flips that completely. It carries high risk and very low stability. And when we talk about speed, trading is incredibly fast, whereas a normal business is much more of a slow, methodical burn aimed at high long-term growth. Let's step into the shoes of a traditional business owner for a second. Building a normal business is incredibly rewarding. You get stable, long-term income, you build lasting brand value, and you actually create jobs for people. But the reality is tough. You need a massive amount of upfront capital. You have to be incredibly patient because the results are slow. And the day-to-day management, dealing with staff, regulations, operations, it's really complex. Now let's switch hats. Think about it from a trader's perspective. As a trader, you don't have to worry about managing a factory or paying hundreds of employees. The operations are beautifully simple, and you can start with very little capital to see fast profits. But it's definitely not all sunshine. You are taking on massive, constant risk. Your income is totally unstable, wildly fluctuating with the market, and you are up against intense, ruthless competition every single minute the market is open. Which brings us to Section 2. What are options? Defining the new world. So we've established that trading is all about speed and leveraging price movements, right? But if you want the absolute ultimate tool for speed and leverage in financial markets, you have to enter a whole new world. Let's talk about options. Here is the core definition you absolutely need to memorize. An option is a contract between two parties. The buyer pays a small fee, called a premium, to purchase a right. The seller receives that premium and, in exchange, takes on an obligation. I really want to emphasize those two words. The buyer buys a right, the seller takes on an obligation. That right there is the foundational concept of this entire explainer. To make this super concrete, let's just play this out. Imagine you are the option buyer. You paid the premium, which means you hold the right to execute this contract, but you have absolutely zero compulsion to act. If the market turns against you, you can literally just walk away and let the contract expire. Now, imagine you're the option seller, also known as the writer. Because you accepted that premium up front, you are locked in. If the buyer decides to exercise their right, you have a strict binding obligation to fulfill the contract, no matter how much money it ends up costing you. And this brilliantly illustrates why options are so unique compared to traditional investing. When you buy a stock, you own a piece of that company, you pay the full price, and you can hold it forever if you want. But when you buy an option, you don't actually own the underlying asset, you just own the right to buy or sell it. You only pay a tiny fraction of the cost, the premium. But, and this is a massive but, options have a strict expiry date. There's a ticking clock. If it expires, it becomes completely worthless. Section 3. Understanding call options. Betting on the rise. Let's get into the mechanics of the two types of options, starting with the call option. Basically, a call option gives you the right to buy an asset at a specific price, which we call the strike price. You buy a call option when your research tells you the market is going to go up. To really wrap our heads around this, let's anchor our math with a baseline number. Let's use the Nifty Index. Imagine the current spot price of the Nifty is exactly 24,000. Just keep that number, 24,000, locked in your mind as we run through these next few scenarios. Okay, so the market is at 24,000 and you expect it to rise. You buy a call option with a strike price of 24,200. The premium you pay for this right is 80 rupees per unit. Since options are traded in batches, let's say the lot size is 25. If we just multiply our 80 rupee premium by the 25 units, our total cost is exactly 2,000 rupees. And here is the magic of being a buyer. No matter what happens, your maximum possible loss is strictly capped at that 2,000 rupees. Let's play a little what if. Scenario A. The Nifty rockets up to 24,500. Your 24,200 strike is now deep in the money. After subtracting your 2,000 rupee premium cost, you walk away with a fantastic 5,500 rupee profit. The upside? Completely unlimited. But look at scenarios B and C. If the Nifty just stays flat at 24,200 or crashes way down to 23,800, your option is worthless. But remember that safety net we talked about? You don't lose thousands. Your downside risk is safely capped at exactly the 2,000 rupee premium you paid, even if there's a total market crash. So betting on the rise is actually pretty straightforward with a call option. But hey, the market goes down just as often as it goes up, right? What if our analysis tells us the price is about to take a dive? How do we capitalize on a falling market without actually owning the asset to begin with? Section 4. Understanding put options. Betting on the fall. That brings us to the exact mirror image of the call option. Enter the put option. A put option gives you the right to sell an asset at a specific strike price. You buy a put when you expect the market to drop. It's essentially a way to profit from downward momentum. Let's look at the setup. The current Nifty is still at 24,000. Because we think it's going to fall, we buy a put option with a strike price of 23,800. The premium for this is 70 rupees. We multiply that by our lot size of 25, giving us a total cost of 1,750 rupees. Once again, because we are the buyer, this 1,750 is our safety net. It is the absolute maximum amount we can lose. So, the crucial point is how this reacts to market movement. In scenario A, our prediction is spot on. The Nifty drops dramatically down to 23,400. Because we hold the right to sell at 23,800, we have a 400-point advantage. Multiply that by 25, subtract our premium, and boom, we have a massive 8,250 rupee profit from a market drop. But in scenario B, let's say the Nifty goes up to 24,200. Our prediction was wrong. The option expires worthless, but our loss is fully controlled and capped at just 1,750 rupees. To really lock this in your memory, let's summarize the mechanics side by side. For a call buyer, when the price goes up, profits go up. When the price goes down, your maximum loss is just the premium. For a put buyer, it's totally reversed. When the price goes down, profits go up. And when the price goes up, the maximum loss is just the premium. Essentially, direction dictates your profitability, but the premium always caps your risk. Section 5. The power of leverage, the double-edged sword. All of this sounds incredible, right? Capped downside, unlimited upside. But you might be wondering, why do people trade options instead of just buying the underlying stocks directly? Well, the answer comes down to one of the most powerful forces in finance, leverage. Leverage is the ultimate superpower of options trading. It allows you to control massive market movements with incredibly small amounts of capital. Think about it. To buy a lot of Nifty shares outright, you would need lakhs of rupees. But with options, as we just saw, you can get the exact same exposure to the index's movement using just 2,000 rupees. It is extreme capital efficiency. But listen, we have to be absolutely clear here. Leverage is a double-edged sword. Yes, large profits are absolutely possible with small capital, but you can also lose 100% of your premium just as fast. If you buy a stock, it rarely goes to absolute zero. But in options, if the market doesn't move exactly how you predicted before that expiry date hits, your entire investment, 100% of the premium you paid, is wiped out completely. Now, what's really interesting about this slide is how it distills everything we've learned today into 5 core truths. 1. An option is a right, not an obligation for the buyer. 2. Call options are bets on the price going up. 3. Put options are bets on the price going down. 4. As a buyer, your maximum loss is strictly limited to the premium you paid. And 5. Leverage brings incredible opportunity, but massive rapid risk. Which brings us to a really crucial question to leave you with today. We know options have a strict expiry date. Every single day that passes, the clock is ticking, and the option loses a little bit of value, something we call time decay. So, if leverage can multiply your gains, but time decay can slowly bleed your premium down to zero before the expiry date even hits, how do you fight back against time itself? Well, that is a fascinating mechanic we will uncover in our next session. Until then, keep learning and stay focused.